Today is Thursday, April 10th, 2025, and this meeting of the Economic and Revenue Forecast Council will come to order. I'm Councilmember Dan Strauss, Chair of the Economic and Revenue Forecast Council. Joined today with colleagues, Council President Sarah Nelson is excused until she arrives, Seattle Mayor Bruce Carroll's Chief of Staff and General Counsel Jeremy Rocca, and City Finance Director Jimmy Carnell. Also joined today from the Office of Economic and Revenue Forecasts, as well as representatives from the City Budget Office as well, and City Council Central Staff. A couple substantive items today we need to act on. The selection of a chair and vice chair for the Forecast Council for 2025. The Council President is now in attendance. Presentation and review of the Economic and Revenue Forecasts, and I will move to have the formal approval of the 2025 work program for the Office of Economic and Revenue Forecasts to our next meeting. Before moving on to items, I will formally adopt the agenda for today's meeting. Is there any objection to the amended agenda moving the approval of the 25 work plan to the next meeting? Seeing no objections, I move to adopt the amended agenda. Is there a second?
Second.
It has been moved and seconded to adopt the agenda. Today's agenda is before the Forecast Council, and this is an opportunity. I guess we already amended it. There are no objections. Today's agenda will be adopted as amended. Hearing no objections, today's agenda is adopted as amended. We'll move on to our first item of business. Our next order of business is to select a chair and vice chair for the Forecast Council for 2025. I served as chair last year, and Chief of Staff Rocket served as vice chair per the ordinance that created the Forecast Council and allows me to elect or re-elect someone for both of these positions. At this point, I would entertain nominations on the floor. We'll start with the chair. Are there any nominations for the chair from the floor?
Chair Strauss?
Yes.
I'd like to nominate you to continue to be our chair.
Thank you. Do we have a second?
Second.
It has been moved and seconded. Are there any comments before I call the vote? Seeing none, I'll now call the vote on the roll of nominating Councilmember Strauss, myself, to serve as the chair. Will ask who is calling the vote? Is that myself? Yes, so we'll start with Council President Nelson.
Aye.
Chief of Staff Rocket. Dr. Carnell.
Aye.
Councilmember Strauss votes yes. So we now elected the chair. With that, I will move on to electing the vice chair. With that, are there any nominations from the floor? I will nominate Jeremy Rocca for the role of vice chair of the Forecast Council. Is there a second?
Second.
Thank you. It has been moved and seconded to elect Jeremy Rocca as the vice chair of the Forecast Council. Any comments before we take the vote? I will go in the opposite order as last time, so calling on myself. Councilmember Strauss votes yes. We'll go with Council President Sarah Nelson.
Aye.
Director Carnell.
Aye.
Jeremy Rocca.
Aye.
The unanimous vote. Congratulations, Jeremy. You are elected as our vice chair. We'll now move on to the second item, which is actually the approval of the meeting minutes from October 22nd, 2024 meeting. A copy of the minutes from that meeting of the Forecast Council has been circulated to the members and posted on the website of the Forecast Council. I would move and seek a second for approval. So I move the approval of the minutes from October 22nd. Is there a second?
Second.
Thank you. It has been moved and seconded to approve the minutes from October 22nd, 2024. If there are no objections, the minutes will be approved. Hearing no objection, the minutes are approved. We'll now move on to the meat of today's agenda, the presentation of the April 2025 Economic and Revenue Forecasts, recommendation from the Office of Economic and Revenue Forecasts regarding the 2025 and 2026 forecasts. This is a presentation of of the economic and revenue forecast led by the staff of the forecast office. The April forecast update is the first of 3 revenue forecasts that we will be reviewing this year. We'll return to the August and October forecasts to receive revised forecasts. The April forecast provides an opportunity to check in regarding revenue assumptions that underlie the 2025 and 2026 biennial budget that was adopted and endorsed by the City Council last year. An updated revenue forecast takes into account the 2024 year-end actual revenues, current economic conditions, and the changes in the economic outlook since this last year. The August revenue forecast will provide the basis for any changes that the mayor will propose during the 2025 and 2026 annual budget. The October forecast will be the final update and will form the foundation of the council's final actions, potentially amending the 2025 budget and adopting the 2026 budget. Today's presentation will be led by the staff from the city's independent Office of Economic and Revenue Forecast. Just as a reminder to the public, this office was established in 2021 and is modeled based on similar independent forecasting offices operating in King County and Washington State. The main purpose is to increase transparency and accountability around the city's revenue forecasting process and to ensure that there's no political influence on the forecasts themselves, to ensure that the Forecast Council is fully informed and able to have a full range of options addressed. Staff from the City Council Central Staff and City Budget IC Director Eater here in attendance will also participate in the briefing. Staff from the City Budget Office is also here to present briefings regarding revenues still in the purview of the Budget Office as well. Forecast Office will present 3 economic and revenue scenarios: baseline, pessimistic, and optimistic. The office will then provide recommendation of which of these scenarios should become the formal forecast. We will have the opportunity to discuss the recommendation, whether to confirm the recommendation or consider a different forecast scenario. And before I turn this over to the office, we'll share what we all know is that the geopolitical economic situation has been in flux quite a bit in the last 7 to 14 days. And so just understanding that it is different. And for those of us who celebrate Passover, why is today different than all other days? Today is different because of the economic fluctuations of the past 14 days. I will also share that because the team presenting here today will be in the budget and the finance committee next Wednesday, I will ask for us to keep conversation short so that we can dive into a deeper conversation with more of our colleagues next week. With that, I'm going to pass it over to Jan. Jan, go ahead.
Very much. Good morning, Forecast Council members. Let me share this. So this is the outline for the presentation today. I'll spend some time summarizing the recent economic developments for the U.S. economy as a whole. Then we'll move on to talk about the national forecast, which is one of the main inputs when we are developing the regional economic forecast. We'll look at that. We'll summarize the performance of Seattle economy in 2024, again, as a starting point for where we might be heading this year, then the next one. And then in the second part, we'll move on to the revenue forecast. Before that, we'll again look quickly at the 2024 revenue actuals, summarize where we ended up, and then talk about the forecast itself. So there is quite a lot of information here. Because we are incorporating those year-end actual revenues in this presentation, the April presentations are usually the ones where there is much more to go over.
My apologies, John. I'm going to have to interrupt you. If you could bring the microphone closer to you. I'm having reports that it's hard to hear you. I'm hearing you fine, but just want to share that.
All right, is this any better?
Slightly, yeah.
Slightly.
Go ahead.
I can move a little bit closer and speak up. So let's look at the recent economic developments. There is a lot of talk about tariffs, and essentially everything is driven by what's happening with tariffs. The chart here summarizes the tariff announcements. Sean, do you know if we can remove that? So the chart here summarizes what the economists call the effective tariff rate, which is a single measure to gauge how large those tariffs are. Essentially taking all the tariffs that are raised and dividing them by imports, by the value of imports, gives a measure of how big of a tax is imposed on these imports. So there has been a lot of development, and it happened quite fast over a couple of weeks and a couple of days eventually. The green line summarizes what the effective tariff rate would be if the tariffs were in place the way they were announced on April 2nd, and there were no further changes beyond that. So the tariff rate spiked before this year. The tariff rate was somewhere around 3%. That spike goes all the way to 23%. So it's a substantial increase in the amount of tariffs imposed, and we would have to go back 100 years to see something comparable. What's more important for the forecast itself, these announcements were made after the March forecast for the U.S. economy was finalized by S&P Global. That's a forecast that we are using as a starting point to develop our regional economic forecast and to develop a revenue forecast. And so that gap between what the economists believed the tariffs would look like back in March and what the actual announcement is shown when we are comparing the purple line. That's the March baseline, essentially the assumptions about the tariffs were that it will go somewhere to 10%, stay there for a little bit, but as you can see, the purple line is coming down as negotiations were expected to take place and the imposed tariffs will be scaled back. So the gap between the purple line and the green line, that's 10% plus, 10 percentage point plus. So it's a substantial change between what were the beliefs in March and what the April announcements were. There's been some developments since then. Some of those tariffs are now on pause, but the tariffs on China were increased beyond those April 2nd announcements. So yeah, it's really a huge increase. It has been summarized by Oxford Economics as dialing it up to 11. Oxford Economics is the source of this chart. We are supplementing our S&P Global's forecast with additional data from other sources when they provide some additional information. This is one particular example where this chart just really nicely summarizes the recent developments and how much they matter. And they do matter a lot. So there is really a lot of uncertainty regarding the trade policy. The top panel in the chart labeled Economic Policy Uncertainty Index is a single measure that tries to summarize how much uncertainty there is regarding economic policy. You can see it spiked quite significantly over a recent couple of weeks, and similar sort of spike that we have seen in early 2020. The onset of pandemic, where there was a lot of uncertainty regarding what the fiscal policy, what the restrictions might look like. So these are really very uncertain times. And then the uncertainty leads to all sorts of important impacts on the global economy. The impact on output prices and employment will not be negligible, but the problem is that it's really hard to assess just how much these tariff increases might cause, how much of damage they might cause to the economy, how much the prices might go up. Even again, the announcements change a lot, and it's hard to figure out where we are, where we might be going, and what the timing might be about those changes. And so the financial markets have been quite volatile. At the bottom part, it's an index that summarizes how much volatility there is in the financial markets. The main takeaway here is that there is again a spike that maybe not as big as the early 2020s or as big as the spike during the Great Recession, but it's a significant increase in volatility. So the path forward is rather unclear. Lots happening, and financial markets are still just trying to get a sense of what these all might be and what the long-term implications might be. Yesterday, the markets recovered some of the losses. The red point is showing what the closing position of the S&P 500 index was yesterday. So it's above the bottom, of a dip shown by the black line. But today the losses continued. The S&P 500 is down around 4 or 5% again. So the sell-off continued, and even this uncertainty and the volatility is expected to linger, even those tariffs have been put on pause, and it's hard to tell where things might be heading. So it has direct implications for the payroll expense tax revenue, as we'll see when we get to the forecast, but there are really considerable wealth effects. They are not negligible because a lot of large share of population is considering the impact on their pensions, on their savings, on their ability to spend, and so they are going to be hesitant to incur any big make any big purchases. Will be all delayed until there is more clarity of where we might be heading. Same sort of thing with businesses. Making any sort of investment or hiring decision is really hard because it's really hard to tell what the economy would look like, what these tariffs would look like, any of these needs. So with that, move now to the forecast. And again, the point here is that what we are going to show is what the forecast looked like based on the assumption back in March. So there is going to be a baseline scenario and a pessimistic scenario. Both had some underlying assumption about what the tariffs are and what the path forward might look like. So these charts here show the October 2024 baseline. That was the forecast that's underlying the adopted 25 budget. The economy was in very solid conditions. It was expected to slow down, so as you can see in the panel on the right side, the employment growth was expected to come down gradually. It's showing the percentage change in the employment year over year, and while it was around 2%, slightly below 2% at the beginning of 2024, it was supposed to or expected to be gradually coming down as those high interest rates were still in place and were still affecting the economy. But the GDP growth was expected to be, again, quite remarkable given the extensive and ongoing monetary or restrictionary policy. Now, moving on to March and looking at the March baseline scenario, it's very similar, slight small changes, but same sort of story. Solid growth expected for this year and the next one. A little bit of a slowdown compared to the growth in previous years. A little bit more of a slowdown in employment, but nothing really dramatic. And that scenario, again, assumes some amount of tariffs imposed on the trading partners. Then, pessimistic scenario that the S&P Global developed in March was slightly weaker outlook. You can see that employment actually declines year over year slightly, about 0.5% decline in U.S. employment year over year in 2026 and 2027. Nothing really dramatic, and really nothing that would be called a recession. So in the panel on the left, the black line shows that the real GDP, even in a pessimistic March scenario developed by S&P Global, was expected to be somewhere around 1%. So no recession in a traditional sense of output declining for 2 consecutive quarters. And so it's something that the economists refer to as growth recession, when the growth of GDP slows down, but real GDP does not decline. What distinguishes these two scenarios is that the pessimistic scenario assumes higher tariffs and assumes a bigger response by the affected countries. So that would lead to higher inflation and slow growth. So here's the chart that summarizes the impact on the prices. So a lot of uncertainty regarding what the Fed might do given the tariffs. They are putting the Fed in a very difficult position because on the one hand, they would want to lower the interest rate to kind of help the economy and avoid larger job losses. On the other hand, tariffs might cause the inflation to go up, and if the inflation expectations become anchored and long-term inflation expectations start to rise, that would make it hard for Fed to bring the inflation back down. And so the assumption was that, the assumption back in March was that given the tariffs are now part of policy of this administration, the Fed will have to keep the interest rate higher for a longer period of time. So in the panel on the right, that panel, those two lines show the anticipated path for the federal funds interest rate in October, and then the path of the interest rate under the assumption of some tariffs imposed, again, kind of like what that purple line was showing in the chart with the effective tariff rate. So again, Fed is was expected to keep the interest rate higher to fight the inflation, to prevent the inflation expectations from becoming higher. And the inflation would spike, but not that dramatically, and eventually would go back to the 2% target. In a pessimistic scenario, again, higher tariffs, bigger response of trading partners, all that implies that the interest rate would have to stay higher for a longer period of time to prevent the inflation from becoming unanchored. The inflation still rises, peaks somewhere around 4%, but the interest rate eventually helps it to bring it back down as the inflation, long-term inflation expectations are not affected. So it's kind of a one-time event, and if tariffs were imposed immediately as a single event, that would work perfectly fine, and that would kind of just not worry about it too much. But given the amount of uncertainty, given the timeline is really uncertain, and maybe potentially adding the additional tariffs over a longer time, the Fed is more likely to be in this wait and see position, to kind of get a sense of how big of an impact these tariffs have on prices, how much of an impact there is on the employment, and when it would be time to start cutting the interest rate. And so the main takeaway here is that given that the two scenarios were developed back in the middle of March, and given the underlying assumptions about tariffs, even though this baseline scenario was supposed to be the more likely one, the current policies in place and the likely response are more in line with the pessimistic scenario outlook. So higher tariffs, higher inflation as a result of that, and that waiting and keeping interest rate higher for a longer period of time, potentially cutting them more aggressively than the pessimistic scenario forecast shows. So potentially there may be some larger cuts at the end of the year, but definitely interest rate higher for a longer period of time. So what does that mean for the Seattle area economy and the regional forecast? We're going to look at that in a second. To get a better understanding of where we are, here is a quick summary of what 2024 year looked like overall, and how it compared to our expectations. Looking at the third set of bars, the ones labeled employment, they show that the employment grew about 0.8% year over year in last year, slightly above our expectations from October, 0.1 percentage point above what our forecast was back in October, and 0.2 percentage points above our expectations back when the 2024 adopted budget was developed. So roughly in line with our expectations, notably weaker as in the national economy, as I will talk about more in the next slide. When it comes to regional inflation, that was above national level, cooled down faster than the national inflation did, and in general, again, quite close to what we were expecting, 3.7 actual inflation compared to 3.6 forecast from October last year, 3.8% forecast from October 2023. Now, one thing where we were further away from, where our forecast was further away from the actual figures is the taxable sales. So in 2024, taxable sales did not really grow. They remain pretty much flat, 0.1%, so rather flat. The spending in the city was weaker than in the national economy, so the increase in retail sales that we saw in the national economy did not really translate to similar sort of increases in the city of Seattle. And an additional and a really big part of what happened is the decline in the construction sector. We have already talked about it a couple of times. The construction sector is in downturn. It declined 7.1% year over year in 2024. So that's weighing down considerably on sales tax collection. The construction sector is around 22%. That's slightly down from the 25, so roughly a quarter, a couple of years ago. Right now, about 22% of overall taxable sales. So considerable part of sales tax is dependent on the construction sector. And then the last very left two bars on the personal income. The actual is missing there. It's not a mistake. We are only going to get personal income for 2024 in November this year. So there is significant lag between when we were seeing it and when we were working on these forecasts. What we do know is that the personal income in Washington State grew about 5.6%. So very similar to what our forecast is for Seattle area. In past, Seattle area, in let's say 10 years before pandemic, it did tend to grow higher than the Washington State. Recently, we have seen a bit of a lag. The Seattle area was lagging in terms of employment growth, for example, but we are expecting to see personal incomes pretty close to what our forecasts were when we eventually see those numbers in November. So a little bit more on job growth. Since we don't have income data, we are relying on the employment data to get a better understanding of where the regional economy is and where it might be heading. As I mentioned when I was talking about those actuals versus forecasts for employment growth on the previous slide, Seattle area employment grew at a lower rate than the national economy, 0.8% growth in Seattle area compared to 1.3% growth at the national level. So that's the red bar versus the blue bar for total non-farm employment. Here's how the different industries contributed or weighed down on the overall growth. Construction sector, again, is in downturn. It climbed considerably. In addition to that, the information sector is still recovering from those layoffs. And so those two combined took a good chunk out of the growth that we have seen in education, health services, and in the government sectors. So overall, yeah, the starting position is weaker for the regional employment forecast. Very modest growth in 2024 was expected to continue in 25 and in 26. That line labeled October 24 baseline scenario is again what's underlying the adopted 25 forecast. Very similar to what the baseline scenario currently suggests for the employment growth. So slightly weaker growth still for 2026. So it's a little bit harder to see given the scale. But if you focus on the part that starts from 2026 Q1, that March 25 baseline scenario is below the October 24 baseline scenario, essentially showing the impact of those tariffs and how they weigh down on the employment growth. So similar sort of stories for the national economy. Some amount of tariffs, slower economic growth, no recession in the baseline scenario, but lower employment growth. So the recession scenario, the scenario of a recession was the one that the S&P Global considered back in October, and the brown line labeled October 24 pessimistic shows what that sort of recession assumption back from October would imply for the employment growth, employment declines here in the Seattle area. And so it wouldn't be a deep recession like Great Recession or pandemic recession, but the number of jobs would decline by about 4.3% between the peak and the summer of 2026. And so again, that was the assumption that in October. In October, we made the recommendation to adopt the baseline scenario because given everything that was going on, we did not really expect the recession to be on the books for next year, this year or the next one. The economies in general entering 2024 were putting roughly 15-20% probability on a recession happening, which is very low in historical standards. So the economy was on a very solid, in a very solid position, and there were some concerns about tariffs, but they were really not on anybody's radar back then. So moving forward to the current pessimistic scenario, the last dark brown line shows what the S&P Global's pessimistic scenario would imply for the regional employment. So again, what we are doing, we are taking the scenarios developed by the S&P Global, using them as an input in our forecasting models to develop those regional economic forecasts for employment, taking into account all the other things that we have that inform the forecast, let's say permits issued by SDCI that kind of inform where the construction sector in the local economy might be heading. So the March pessimistic scenario, again, implies some job losses. About 1% year-over-year decline at the beginning of 2027. So that's something that in some sense would resemble a mild recession, again, not a particularly deep one, but it would not be a recession in a traditional sense, in the sense of national economies, output, real GDP declining, again, because that's not the pessimistic scenario. The March pessimistic scenario assumption is it's just a gross recession, not a traditional recession where GDP declines. And nevertheless, it would mean about 1.5% total decline from peak to trough between the second half of 25 and the summer of 2027. So those are the economic forecast. Now moving to the revenues, again, looking first at the revenue actuals to get a sense of where we are starting at the beginning of this year. A little bit of information of how the revenue is coming in throughout the year. We are in April. Typically in April we don't really know anything other than some information on rate. We don't have any sense of where the current year actual revenues are heading. For rate, we have 3 months of tax collection. So in last year it was roughly 20% of the overall revenue for the year. For other taxes, the only thing that we do have is a sales tax for 1 month, so roughly less than 1/12 of the overall collection that we are going to see throughout the year. And then usually there is a little bit of property tax, but in general, for business and occupation tax, for payroll expense tax, there isn't anything that companies would pay at this point for the current year obligations because the due dates are only later this year. So what the revenue forecast is informed by is last year actuals and the economic outlook that we went over. This table summarizes, and it's a lot of information in one place. It's the same sort of information that we send out as part of the 2024 year-end revenue report. It summarizes our forecast from October and the actual revenues, compares those two, and shows where the actuals came short of the forecast and where they outperformed. Overall, if you focus on the very bottom line, it's labeled total general fund without grants and transfers. Taking out the grants and fund balance transfers, the general fund came in 7.3 million above the expectation, so around 0.5% above the forecast. So small variance. Part of it, 2.3 million of that is higher than expected sales tax revenues. So there were some non-current payments that were higher that pushed the sales tax for revenues above the forecast. Overall variance is about 0.7% for sales tax. For business and occupation tax, there was less revenue, about 700,000 less than forecasted, which is 0.2%. So those two combined came in about 1.5 million above the forecast, which is around 0.25% variance from the forecast. So in general, in line with our expectations from October. One particularly large number that jumps out here are the grants, and Dave and Alex can provide some information on that.
Oh, sure. So for grants, the forecast in October was inflated by what we call grant carry forwards. Essentially, each grant is appropriated fully at the beginning when the grant is accepted, and so this is just indicating that a lot of grants are usually spent over multiple years and have not yet been spent, and so the revenue has also not been received. And this just means that that amount is also going to continue to be carried forward into the next year.
Yeah, so that's the reason why those two bottom lines why there is a big difference between them, taking into account the 45 million less in grants means that the total general fund, if we include the grants, came in 38.8 million, or 2.2% below the forecast. But it's a carry forward, and you'll see how that affects 25 revenue forecast in a second. Before moving to that, let's look a little bit more closely at those main economically driven revenues. Again, they do what happened last year informs the forecast and gives us a sense of where different parts of the economy are. So for business and occupation tax, the base is really well diversified. Business, professional and business services are a larger share, notably a larger share than the others, but it's definitely more diversified than the sales tax revenue, for example. What we have seen in this year is a decline in those professional business services, trade, and information sectors. So those where a large share of revenue is coming in, they actually declined year over year. There was an additional 11% decline in the construction sector. So overall, the performance was weaker than, say, a year before that, and definitely weaker than a long-run average that we have seen in the last decade, taking out the 2020, which was affected by the pandemic. So for trade, information sector, and professional and business services sector, they declined combined overall. Tax obligation in these three sectors declined by a combined 2.7%, after growing 9.1% in 2023 and after growing on average about 8% in the period from 2010 through 2023. So that's somewhat concerning for the outlook as well. For the sales tax, the 2024 actuals again came in slightly above the expectations because of some non-current payments. What that implies for 2025 is it doesn't really imply that we are going to see that we should see a higher. That did not compel us to revise the forecast much higher. Our expectations are to a large extent formed by the outlook for the construction sector. Again, it's about 22% of revenues right now, so roughly a quarter. Trade accounts for a third of revenues, and again, as you can see, it declined last year. People are again possibly quite hesitant to make large purchases. Car sales are significantly down. Tariffs might be again something that might compel some of them to make a purchase before those tariffs are in place. But for the overall 2025 year, it's certainly not something that would suggest a larger growth in this sector, in my view. So overall, just like for business and occupation tax, there is a large amount of taxpayers, 20,000 for business and occupation tax, roughly 70,000 taxpayers for sales and use tax. Relatively diversified revenue sources and not particularly concentrated revenue sources. So the top 10 taxpayers, they account for 20% of the business and occupation overall revenues, and they account for about 11% of sales tax revenues. So that's quite different from the payroll expense tax. One more thing, I guess, that might provide some idea of what the sales tax revenue are heading, where they are heading, before we get to payroll expense tax. This chart here shows the overall year-over-year growth in sales tax revenues. That's the black line. Sales tax revenues have grown considerably in 2022. There were a lot of spending on goods. The economy was recovering, so leisure and hospitality revenues were up. construction sector, there were still some projects in the pipeline that were finishing up, but as they were getting to the completion, you can see that the sales tax revenue started to decline as the construction started to really weigh down on the overall sales tax growth. Starting from the second half of 2023, sales tax revenue has been mostly declining year over year, with some exceptions of that happened early 2024, and this November spike here, again, it's partially due to some non-current payments, partially due to potential impact of tariffs on front-loading of purchases. For the single months that we have in 2025, so the very last point on the black line, sales tax obligations declined 5% year over year, so 5% down in January 2025 relative to January 2024. And again, a large part of that is the construction sector. So those individual bars, they stack up to the total, and they show which sectors are weighing down, which are contributing to the growth. The yellow bar is the construction sector, that's pretty much.
Yeah, I'm getting feedback again that your audio is difficult to hear. I can make out what you're saying, but I think that's because you and I had this discussion beforehand. I'm going to ask you again if you can bring the microphone closer to you. I'll make an editorial comment here for the group that I think that we need to, in working with the vice chair, to understand a better forum for these meetings. I know that we moved the forum to the mayor's conference room to as an improvement over 370, but I might recommend that we use council chambers, which is already set up for Seattle Channel and has individual microphones. So for the listening public right now, also be aware that we will be having this presentation again next week in council chambers. So if there's something that you're not hearing today, you have another opportunity to receive this information. And Jan, I will also request for the future meetings that rather than having your bullet points show up one by one, that they just all appear at once or not at all. So I'll turn it back to you and let's continue through. Thank you.
Okay, thank you. So the final of the three main taxes, the payroll expense tax, here's what 2024 actuals look like, broken down by industry. It's quite different revenue source compared to the other two that I talked about. It's only paid by less than 500 companies, and it's really highly concentrated. The concentration has gone up in the last couple of years. Right now, the top 100 companies, top 100 businesses account for 93% of the revenues. About 75, so about 3/4 is just 10 companies. 9 of those are in the tech sector. One note here is that tech sector does not mean the information industries. The classification in this chart is based on the NAICS codes, and what people consider tech companies to be are companies that would show up in trade, for example, Amazon.com services. They would show up in professional and business services, that would be AWS. So not necessarily companies in information sector, and they are in those three sectors that we often talk about and focus in these presentations: the trade, the information, the professional and business sectors. So it's a highly concentrated source that's very hard to forecast, and this is where our forecast was quite off for last year. Our baseline scenario forecast was 406 million. Pessimistic scenario forecast in October was 361 million. The actual revenue for the year was 360 million. So that means about 46.7 million below the baseline scenario forecast. It's 11.5% gap, and about 1.2 million or 0.3% less than the pessimistic scenario forecast. The table at the bottom shows how those forecast errors compare to the accuracy of our forecast in the previous years. In relative terms, it's about the same magnitude of a forecast error. We have seen 46 million more in in the previous year for 2023 actuals, so that was about 17.3% above the forecast. The year before that, the actual collection was 26 million below the forecast. That's about 9.5% gap. The very first year was particularly imprecise. We did not have a good source of information to inform the forecast. Eventually, the collection was close to 300 million, and the forecast error was 100 million, almost 100 million, so 47.7%. So, in terms of the relative size of the error, it's definitely much larger than the one for the sales tax, for the business and occupation tax. A little bit more information here on what we believe the reason is why the actuals underperformed the forecast. We have talked in the past why we believe the stock prices are an important factor, and why payroll expense tax revenues are quite dependent on the stock prices. That was one of the main inputs in the forecast. The chart here summarizes the expected stock price performance for a couple of large tech companies. The gray dots show the expected year-over-year growth back from October, the expectations for the year-over-year growth as we were getting to the close of the end of the year. The blue dots are the actual year-over-year growth in 2024. So in general, stock prices grew in line with expectation, outperformed in most of the cases. So that's again something that is hard to put together with our assumptions about the role of the stock prices for the for the payroll expense tax revenues. In addition, one has to take into account the fact that the collection, the 360 million in payments, are not all payments for 2024 obligations. There were some payments for the previous years, and only about 347 million are payments for 2024 obligations. So that means that the growth was actually even smaller than the 14.2% total. It was around 11.3, and about 6.5% of that is essentially because of higher tax rates that were in place starting in 2024. So adjusting for those non-current obligations, adjusting for the increase in the tax rate, the growth of the obligation, the growth of the tax base is only around 4.5%. Again, very hard to square with the performance of the stock market and the performance of the stock prices for those main taxpayers. Right? So, in addition to that, the 2024 stock price growth was even stronger than the year before. Looking at those same companies that in the previous chart, but rather than looking at their growth of their stock prices in 2024 and comparing it to the expected growth, this chart now shows how the stock prices of those companies evolved over time. And 2024 was a particularly strong year for a stock market. Meta, like still Facebook in this chart, the stock price for Meta grew close to 100%, so almost doubled year over year. For Amazon, the growth was 50%. So again, given what we believe the role of restricted stock units is, what the role of stock prices is for the payroll expense tax revenues, that is somewhat of a challenge to put with the actual revenues. So what we did, we looked at the data, the new data that we now have available. We have entered into a sharing agreement with the Employment Security Department, which provides us with access to total payrolls and payrolls by employee for companies in King County. So one thing we can do is we can look at companies that are main taxpayers for payroll expense tax and compare the growth or the change in the payroll expense tax revenues paid by the companies with the wage growth of those companies in King County, and with some additional effort, in some cases we can look more closely at the change in the payrolls, in the total wages paid in the city of Seattle specifically. And so this chart tries to do that sort of comparison. So given that we have seen a strong growth in the stock prices, and given our assumptions about how stock prices matter for wages, we were trying to understand whether the total wages in King County grew with what those stock price movements would suggest. And that's what the blue line shows. So the blue line here shows the year-over-year change in the total wages in King County, only for the top 15 payroll expense taxpayers. And we are trying to do adjustment here for different tax rates in different tiers, because highly compensated employees their compensations are subject to a higher tax rate. So we are taking that into account and calculating again the year-over-year change in the wages in King County in 2024, which came for those top 15 taxpayers, based on these estimates, somewhere around close to 35%. Again, also taking into account that 6.5% increase in the rate. So let's say 30%, slightly below 30%. So that's significantly more than the growth of the tax base, the growth of the PET, payroll expense tax revenues, which again, looking only at the current 2024 obligations, was 11%, adjusting for the fact that we received some payments for 23, some payments for 22, that growth is only around 11%. So wages did grow again in line with that expectation that stock prices, when they are growing fast, the wages of the taxpayers of those companies are growing fast. The thing that we are now trying to work on is figuring out why the Seattle tax base has been growing much weaker, much slower than the King County's total wages. So finally moving to the revenue for.
If we could go back to that last slide just before we move on, I just want to confirm my understanding that when you're running these numbers, the 2024 actuals versus forecast, this was up until December 31st, 2024. Is that correct?
So what we have right now, and that's a good question. What we have right now are the data from the Employment Security Department goes through the third quarter. So we have the first 3 quarters of 2024. What we did, we looked at how big of a share the first 3 quarters historically are in the overall annual compensations, and estimated the total of 2024 annuals, so total compensation for the whole year. To have a reasonable apples-to-apples comparison, we are estimating the overall wages that were paid in 2024. We'll only know that in a couple of weeks from now, when the fourth quarter data, when we receive the fourth quarter data from Employment Security Department.
Okay, thank you. Just to clarify, and maybe a yes/no answer is what I'm looking for here, is that this information is not representing any data from January 1st, 2025 through today. Is that correct?
No, this is really just information for 2024. It does not. We will have the first quarter data on wages and employment in summer, before we work on the August forecast. We'll have the first quarter and we have some sense of where the 2025 year is heading.
Okay, thank you. I just wanted to clarify that because I know that even some of us here at the city and the private employers changed their work from office requirements in the first few weeks of January of 2025, and just confirming that this representation does not include that data or information. Is that correct?
That's correct, yeah. So in addition to the employment security data on total wages, we are incorporating the estimates of some measures of the return to the office. We have data from Placer AI, which is location analytics company that provides aggregated anonymized data on the workforce presence, so we can keep track of what fraction of workers are returning to the office and what trends there are. And we have seen in past upticks when major employers change their policy, move to 3 days in the office. And we are starting to see that effect. You mentioned the additional employees coming to the office starting from January 25 are showing up in that measure of workplace presence. That's another input in addition to the stock prices and in addition to the new ESG data. So that's what will be incorporated in the forecast in August.
Thank you. Let's keep moving on. I just wanted the record to reflect that this does not include 2025. And Jan, I will ask you again to get that microphone closer to you. Thank you.
Okay. So we are now finally moving to the April revenue forecast for 2025 and 2026. The table here summarizes the general fund revenues. The first column are 2024 actuals that I went over. The next two columns are showing the current forecast, the April forecast. So as you can see, again, focusing on the very bottom line, focusing on the total general fund revenues, excluding grants and transfers, we are forecasting growth in total general fund revenues of about 2% and growth of about 2.7% in 2025 and 2026 respectively. So the baseline scenario assumes a modest amount of growth. What's more important for budgeting purposes, however, is that the forecast has been revised down relative to the adopted budget forecast. So those three additional columns in the table that just showed up, they show the difference for the 2 years, the dollar amount difference, and the total 2-year difference for individual revenue streams. Overall reduction is about 9.5% without grants and transfers for the 2 years, and it's essentially coming all in the second year. So the first year revenues are slightly higher, 3.8 billion above the adopted budget forecast, but the second year, 2026, is about 13.3 million below the previous forecast. It's a broad-based reduction, essentially driven by the slower economic growth that is part of the regional economic forecast. So that's the reason why sales tax, while business and occupation tax are down about 4.5 million combined over the 2 years. I want to note here that the forecast office is responsible for a relatively small number of revenues in this table. Those highlighted blue. The rest of the revenues are the forecast for those are overseen by the city budget office. So Dave and Alex can provide some additional information on the reasons for the property tax, parking meters, and recorded fines.
Great, thank you. So for property tax, about 2/3 of that is attributable to lower AV assumption than prior for the adopted budget. And a reminder that in 2026, well actually fall of 25 here, we'll be voting on the renewal of the EMS, the medical and EMS levy, and that'll be coming in at proposed at a 25-cent rate, and with AV dropping 25 cents times less AV gives you less revenue. About a third of that, though, is the general expense levy, and that is due to declining new construction assumptions. Moving down, excuse me, not much to see in utilities. Maybe a comment about parking, Joe?
Sure, yeah, I can handle that one. Parking meters, you can see, are down with this forecast, and that is mostly related to moderating of the rate increases that happen quarterly around the city. In fact, they've been, the rate increases have been sort of neutralizing over time, and this most recent one that took effect in around March 10th of this year actually saw an overall rate decrease in the city of about 3.5%. So we had twice as many areas of the city saw decreases as saw increases this time, which suggests there is, we may have plateaued in our demand for parking in some of these areas. And the outlook for future rate increases reflects this now.
Great. Moving microphones here. Great. A comment quickly about the licenses, permits, interest income line. That decrease in 2026 is entirely due to reduction in our cash balances in the cash pool attributable to the general fund. And so we're maintaining relatively high, for us, interest earnings at about 3.6%. But our cash balances that contribute to the general fund have decreased at the end of 2024 primarily. And then we have service charges and reimbursements, which we have a comment about.
Yeah, so there was a notable reduction in the internal service rates for SDHR last year that was not captured in last year's forecast. And so now it's reflected here.
Right. And this category, service charges and reimbursements, is a lot about internal flows of money between departments, between funds within the city for allocated costs and so forth. So that's what we have.
Grants.
Oh, and
Grant.
grants, this ties back to the 2024, where we saw a shortfall in grant revenue. So again, that's just appropriation that has not been used for a lot of these grants carrying forward again, and we're assuming a one-to-one relationship between appropriation and revenue. So if the grants have not been spent down yet, we have to go up in that revenue.
So that was the baseline scenario. Moving to the second one, the pessimistic scenario forecast. Again, first two columns summarize the 24 actuals and the April forecast. Again, what we have here is not a decline in revenues year over year in 25 or 2026. There is a modest growth in revenues forecasted in the April forecast update. Again, where the reductions are, and where we are seeing less revenue is when we are comparing the April forecast with the adopted budget forecast. Now, those reductions, those downward revisions are much larger than in the baseline scenario. Again, this is a scenario where the S&P Global forecast, it's not a recession forecast, it's just a slower economic growth, higher impact of tariffs, tariffs which have larger impact on prices that push the employment growth down, and because of that, because of the timing when these changes will take place, there is a significant reduction, especially in 2026. So it's about 40 million overall reduction in their forecasted revenues, driven to a large extent by a downward revision in sales tax and business and occupation tax. Again, as revenues.
Yeah, essentially the same story, that with gloomier outlooks and more uncertainty, all boats are falling. Nothing been particular in any given line item here to explain it other than a more negative forecast from the region and so forth.
So that summarizes the pessimistic scenario for general fund. Moving on to the non-general fund revenues and looking at the baseline scenario first. Again, the payroll expense tax revenues came in below the forecast. It's 360 million. For 25 and 26, the current April baseline scenario forecast is 373 million and 391 million. So that's a downward reduction of 67 million for the first year and 75 million for the second year. That's essentially basically taking into account the lower base that we are starting from, the ESD data that we are now incorporating into the forecast is one part of the story. The second part, the second reason is the slower stock, weaker outlook for a stock market. S&P Global was expecting the S&P 500 index to grow about 5.5% back in October. That has been revised down in that March scenario, baseline scenario, to a 2.2% growth or so. This baseline scenario is trying to take into account the recent developments. So we were looking at the individual stock prices of those main taxpayers, what happened over last week, how it might affect the overall changes throughout the year, what the outlook might be, and that's another reason why this particular revenue stream has been revised down so significantly. For admission tax revenues, again, there was a little bit less revenue in 2024. That's a part of the story. The other part is less tourism, fewer people likely to visit Seattle, wealth effects, people being less likely to spend on travel because of concerns about where the economy might be heading. For rate, the downward revision in 2026 is the result of higher interest rates that will be in place for a longer period of time, and that kind of again limits the amount of sales and decreases the amount of rate revenues collected. For the other revenues, the budget office is forecasting.
Sure. So sweetened beverage tax, it just generally reflects 2024 revenues came in below forecast, and so it essentially reflects a downward revision. But there are signs of wage effects, inflationary effects that may have some impact on consumption of sweetened beverages. There's even an article in the New York Times about people are bringing their lunch to work more than buying out now. So who knows? But that's that. Short-term rental tax is pretty small. The vehicle licensing fee, again, a small change. Just assumption about new car purchasing, new registrations being added to existing, just a slight downward revision. And then the commercial parking tax, Alex?
Yeah, some of this reduction is due to a base effect. So there was less activity in 2024 than expected, and so that's cascading into 25 and 26. And the other piece is that growth rates across these 2 years have declined just a little bit due to weakening tourism, slightly weakening outlook.
Now, finally moving to the non-general fund revenues and pessimistic scenario outlook. Similar story, similar reason, just larger reductions because those effects of tariffs, these economic slowdown, it's weighing down on those revenue streams even more. For payroll expense tax in particular, the assumption about where those stock prices might be heading, the outlook is more conservative in the pessimistic scenario, but again, informed and what we believe realistic, even what we have seen in the last 7 days, and even how much the uncertainty, the future uncertainty might stock market in general. So to summarize the forecast, move to the scenario recommendation. The S&P Global's forecast that served as a main input assigned 50% probability to the baseline scenario and only 25% probability to the pessimistic scenario forecast. That was back in March, back before all the announcements regarding tariffs on April 2nd, before the recent changes over the last couple of days, where the outlook has really deteriorated quite fast and quite dramatically. There are certainly a lot of risks to the forecast, regardless of which scenario is going to be approved. The amount of uncertainty is really remarkable, whether we are looking at the policies implemented on the federal level, states, proposals regarding tax policies, whether we are looking at the local changes. We have a new tax that's in place starting this year. All those are going to have impact on the job growth in Seattle. That's hard to quantify, that's hard to assess. And they are certainly not things that would compel us to revise the forecast or consider there to be a lot of upside risk. Washington State and Seattle, in addition, are quite dependent on trade and tourism. The trade policies, the impact of all that's going on the amount of travel from Canada, and the wealth effect for U.S. citizens, how much they might be spending on travel has to be taken into account. The high interest rates are going to be in place for a longer period of time, and they will weigh down on the construction sector even further. So all those things essentially mean taking them as a total. What do we see here? Recent developments that pose considerable risks to the forecast. The current outlook that's more in line with the pessimistic scenario than the baseline scenario outlook, and because of that, the forecast office is recommending to use the pessimistic scenario revenue forecast for the April 2024 official revenue forecast.
Thank you, Director Perez. Is there anything further in your presentation?
I'm happy to take any questions and provide additional insights.
Okay, thank you. We are going to open the floor for colleagues that have any questions. I will start with the Forecast Council members, Dr. Carnell, Attorney Robin, Council President Nelson, and City Council President Nelson's hand up. I will also remind colleagues that we will have this presentation back in Finance Committee next week. Council President, the floor is yours.
Thank you very much for this very thorough presentation, although it's disheartening. I appreciate the work that went into it. And so just to repeat what I heard, based on your presentation, the three main I'm focusing on the payroll expense tax because that's a big change in the forecast. So PET, I'll say. Based on the presentation, the main determinants of PET revenues are stock prices for companies that are subject to the tax, or the large payers at least, the wages paid to impacted employees, and the number of jobs in Seattle that are subject to that tax. And then the presentation also showed that in 2024, wages and stock paid to employees, those two factors, wages and stock prices, were up. So that leads me to conclude, or is it reasonable to conclude that it's the number of jobs in Seattle subject to the tax that is driving the change in forecast? And I ask that because even if granted this forecast does not take into account return to work, that from January on, what matters is that they're returning to work in Seattle, and we do have some leasing information and other indications that those jobs are going to other municipalities. I'm thinking about, I was reading Peak Wire article about, Meta's leasing activities in Seattle versus the east side, et cetera. So is that a general conclusion that is reasonable?
So for 2024, we do believe that a big part of why we missed the forecast is that we did not factor in completely the change in the number of jobs located in Seattle. You mentioned Meta. Meta has not renewed some leases in South Lake Union and moved thousands of employees out of those buildings, and they are expanding in Redmond.
Yes.
That's in addition to the 10,000 jobs that have already been reported as lost in Seattle in Amazon over the last couple of years, and the expansion of Amazon in Bellevue. So that's a part of why the 2024 actuals are below our forecast. That's our belief based on the overall data and our sense of the data. For 2025 and 2026, we are now starting with a lower base, and that's a part of the story. In addition to that, the outlook for stock prices is weaker. So the reductions in the forecast are not just taking into account the new source of data that we have from employment, what we have learned over last year about the employment, but also takes into account the downturn in stock prices, and that's a significant part of the story for the forecast.
Follow-up question, if I may. So do you track the number of jobs in other municipalities in King County? And this could maybe be an offline or a next meeting question, but at some point I'd be interested in knowing between stock prices and number of jobs, which is more determinative?
We have done some work with Sean recently, trying to get some publicly available data in addition to employment security data. So we are tracking the changes in the employment, how the Bellevue, the Redmond, and Seattle headcounts for main taxpayers evolved over the last couple of years. So yeah, we
Okay,
can provide
thank you.
Thank you, Council President. Any further questions, Director Carnell, Chief of Staff Rocket? Seeing none from the Forecast Council, I will also note, and can you confirm with me, Jan, I believe that the Jumpstart tax has only been in effect for 4 years, collected for 3. Is that correct?
Yeah, it's been in place. The first collection came in 2022. So for 2021 tax year, so we have 4 years of collection.
4 years of collection, and am I correct that most prudent analysis is a 5-year smoothing analysis to understand trends in taxation?
That would be a reasonable approach. That would smooth out some of the year-to-year changes under normal circumstances. Yes, I mean, you have to take into account how standard those 5 years have been, whether there have been any changes in the policies, for example, that would cause changes in the behavior. And it's really hard in a relatively short history to use some averages. There's additional things we have to do.
Thank you. Thank you. I bring that up just to note that because this is still a new tax policy on the books, that we don't have enough data to even engage in a 5-year smoothing analysis to understand long-term trends.
Yeah.
With that, colleagues, I will move us on. So within the ordinance here, we do not need to vote on opting the recommendation from the forecast office. And Jan, you can, leave it there. Thank you. And if somebody does have a proposal to not opt the recommendation, which is the pessimistic scenario, we will take a vote. Generally and overall, I will say that this is not news, but it could be much worse. I think it is prudent for us to adopt this pessimistic scenario because we do still have another 2 revenue forecasts before the final budget is created. We have a revenue forecast before the mayor's office has creates their proposal and then another revenue forecast before the council finishes their work. And so I think it is prudent and in the best interest for the city of Seattle and our residents, we adopt the recommended domestic scenario. Are there any comments, questions, concerns on that? I'm seeing none, so I will move to adopt the 2025 forecast office's work. I will move to adopt this pessimistic scenario as recommended by the forecast office. Is there, and so let me, because I was in the wrong place in my script, I already moved on. In terms of approving the forecast, if we concur with the recommendation of the forecast scenario, no formal vote is required. Though the original legislation was to remove any risk of political influence over the forecasts, and receiving recommendations from staff of independent experts is the best way to achieve that aim. Are there any objections to receiving and approving the recommended pessimistic scenario? Not having heard any objections, I'm going to direct the forecast office to record our concurrence with the recommended forecast in the meeting minutes. That is. With that, I believe that brings us to the end of our amended agenda for today, colleagues. And for the general public, I understand we try to make improvements on the meeting format here by moving the conference rooms. And Vice Chair, I would like to work with you before the next meeting to work out the technological issues here.
Absolutely. Already looped in our wonderful folks at the Department of IT to see what we can do to make it a better user experience.
Fantastic. With that, colleagues, are there any questions, comments, concerns for the general order? Seeing, hearing none. We are adjourned. We have reached the end of our formal agenda. Before adjourning, I want to remind everyone that we will have 2 additional meetings this year, one in August, one in October, to receive updated forecasts. Our next meeting will take place on Monday, August 4th at 9:30 a.m. If there are no further questions, we will be adjourned. Hearing no further questions, we are adjourned. Thank you.